Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, welcome back. So, don't get a motorcycle, it's dangerous. So, a few things before we get started. So, we got a lecture today, which is not part of this course or anything, a special lecture. We've got a visitor from the Fed, specifically the Federal Reserve Board, coming at 4. So, I'll try to finish early. If those of you who are interested, I hopefully will have the time. So, I don't even know where the Forestry Lecture Theatre is. So, if you do, I'll just follow you. I'll try to make it. Financial crisis, of course, is a very fascinating discussion. Even 10 years later, it's still fascinating. To some people, to me, definitely fascinating. So I'll try to finish sort of around 3:40. So for those of you who are interested, is anybody going, by the way? Do you know where the Forestry Lecture Theatre is? Okay, so we can follow you. Definitely, if you have 1 hour, it's 1 hour of your time, to discuss something that's probably the most important topic in finance in the last 10 years. Certainly more important than anything else I can think of. I mean, the crises, the 1929, if you're a student of the Great Depression, that's good for you. It's very, very useful time to study. 1929 crash is very fascinating. The 87 crash, a little less fascinating because it was more like a liquidity crash. The 2001 IT crash was also not as fascinating because it was mostly overvalued IT companies that had a PE ratio of 105 that had no earnings, right? And the whole industry just crashed, so a lot of cheap money around, so a lot of that went into IT, and 95% of the companies failed. So it wasn't that fascinating. But 2008 was a very fascinating crisis from many, many perspectives. So this person will talk about that. So I'll try to be as brief as I can. Second of all, those of you in tutorial this week and Thursday, this time, Jan is away. So I was able to find replacements for all his tutorials except that one. So please go to an alternative tutorial if you're in that tutorial. I could not find anybody to cover that tutorial. Heda and Badia, they could only do so much, right? They have their own problems as well. So so no tutorial there. Sorry about that. I tried to cover it, but I couldn't find anyone. With that ado, let's have a look at this lecture 10 business. So the story today is really about the investment decision and the investment recommendation. So I've talked to you about, last week we talked about sensitivity and scenario to sort of answer the question, what if, the what if questions, which are always important. The idea behind this lecture is to come up with a recommendation. And that is whether you should buy, sell, or hold the stock that you should recommend your clients to buy, sell, or hold the stock. And it's not as simple as you taking your assignment number 1 or assignment number 2 share price valuation and comparing it to the current price. And then, the current price is here, my valuation is here, the difference is maybe 10% buy the stock, right? Or 5% difference. When it's 5% difference, you wouldn't recommend to buy a stock, right? Because it's just not enough difference. After you incorporate all the transaction costs, and all the risks, 5%, you can basically get that at like a bond portfolio these days. I mean, pearls are giving you, so corporate bonds in Australia, a very popular corporate bond is the pearl. The pearl is a Commonwealth Bank product. That's a corporate bond for Australia's largest retail bank, the CBA, the Commonwealth Bank. So if you type in CBA, you click on key stats here, you click on hybrids. As you can see, pearls, so that's what this means, are giving you the BBS, even some of them are even giving you BBSW 3 month. So the current BBSW is what? 3 month bank bill swap rate is currently what? Let's have a look. 2%, right? So this bond alone is giving you 7%. And that's a corporate bond. That's a bond, so it's collateralized. Remember, shares are uncollateralized. So if the company fails, you basically get nothing. So if the difference between the current share price is here, and your valuation from assignment number 1, assignment number 2, overall composite valuation is only 5 or 6 or 7% more, that's not enough, right? And even if it's 10% or 12%, should you have a buy recommendation? It's not as easy as that. It's not as simple. You shouldn't just, first of all, there's no guide that says, oh, if it's more than 15, buy, if it's less than 15, sell. You'll never find that in any textbook. There's no rule or anything like that that you can use and reference. It's all subjective. And second of all, it's not just about comparing two numbers. Anyone can do that. It's very easy to compare two numbers. It takes 10 seconds, right? We have to think of something, we have to think of the other things that also affect our recommendation, right? So when you open up an equity research report, which it's not an assignment anymore in this class, it used to be, it's not just a question of, you coming up with the target price for your company, comparing it to the current price of the company, whatever it is you're valuing, Caltex in this example, and saying, oh, it's a 10% difference, sell. If that was the case, there would be no equity research report. It would just be one page with this table in it. Equity research reports, as you've been hopefully reading for JB Hi-Fi that I gave you at the start of the semester, are not one page. Right? They're easily 20, 30 pages, some of them 7 pages, definitely more than one, right? And it's not just a simple comparison of two numbers to come up with a buy, hold, or a sell recommendation for whatever company, in our case JB Hi-Fi, but for whatever company you're valuing. It's more complicated than that. So that's what today's lecture is about, right? What else should you think of? I've taught you the tools, DCF, PE, EVM, price to book, sum of the parts, cash flow multiple, all these things. But how do you actually tell your clients to buy, hold, or sell the stock? Yeah. It's not just a comparison of two numbers. Sometimes it's obvious, right? When your share price is here, and your valuation is here, and the difference is 60%, yeah, it's a buy, obviously, right? But even with that situation, when it's obvious, you still need to consider some of the things that I'll talk about today. Yeah. So today's lecture is, it's about, what do we have here? Value and share prices, comparison of the two, but also very important non-valuation aspects that we need to consider that relate to share price fluctuations that go into, it's a factor when you decide to recommend a buy, hold, or a sell for your stock that you're valuing as an analyst. So this is an important slide. I want you to, don't worry about any ratio. I know you're worrying about ratios now because the second assignment is what you're working on, but very fundamentally, if you like, the ratios and your DCF, what they really are trying to calculate is underlying value. Fundamental value, underlying value, it means the same thing. Right? And that valuation is, as you are figuring out, a mix of growth of your company and the return on invested capital. There are many factors that go into that, but overall it comes down to ROIC versus WACC, ROIC minus WACC spread. And if it's above zero, it's a positive and the company's making money. And that's fundamental value, this relationship between the cash flows the firm you predict is able to generate in the future and how they are discounting back to time zero to come up with a valuation. And that valuation, as you found out in assignment number 1, and you're figuring out in assignment number 2, depends on a lot of assumptions about growth, about WACC, about and eventually affect the outcome variable, which is ROIC. Right? And long-term value, actual value of companies is determined like that. That's how it works. Fundamental value is determined by the 4 factors I've discussed before. Growth, capital turnover, the margin, operating margin or EBITDA margin or NOPLAT margin, whatever you want to use, and WACC. Those 4 factors, which is what bare bones looks at, Remember, bare bones is the model that reduces the whole fundamental valuation down to those 4 determinants. If I can find it. Right? It distills, if you like, it reduces fundamental value or the underlying value down to just 4 drivers: growth, your efficiency ratio, NOPAT margin, and your WACC. And underlying value, what you as an analyst are predicting, is focused on this. And what the slide is trying to tell you, that in the long run, this is what the value is. However, we do have a situation where the market price, the market assessment of your stock, and this fundamental valuation that you're doing in assignment number 1 and 2 do differ. The whole definition, I always get asked this question, not by students, but by family members of all things. You know, I read a lot about bubble this, bubble that. What's a bubble, right? What's an asset bubble? Bubble, you know, I know bubbles from, you know, chewing gum. It's like, well, there's no formal definition of a bubble, but the best one I can always come up with that people can relate to is a fundamental departure between stock prices, market prices for something, and fundamental value. So the valuations in assignment number 1 and 2. So this is the valuation from a fundamental cash flow perspective. And if this is different completely, if the valuation you get using this approach, assignment number 1 and 2, is completely different to the market price of the company that you're valuing, and by very different, I mean 30, 40, 50%, and obviously the price is here and the fundamental value is here, that's a bubble. So a bubble, there's no definition, formal definition, but it's essentially a significant and large departure of market prices from fundamental prices, or fundamental value is the better word. And it happens. It happens more often than you think. And the best example is Bitcoin. I know I keep talking about it, but it's a very clear example where the market price of Bitcoin is whatever is $9,000, and the fundamental value is 0. That's the most extreme example of this bubble. I mean, Bitcoin is a bubble. It's worthless. There's no earnings whatsoever. By buying Bitcoin, all you're hoping is, oh, you're excited about the price, and somebody in the future will come and get more excited about the price and buy it, and you sell to that person. So you're speculating. That's all you're doing. There's no fundamental value there. With shares, luckily, we don't have that, because these companies, shares of which we can buy and sell, or as analysts recommend our clients to buy and sell, do have this fundamental value. So that's what we focus on. If I set an assignment, calculate the fundamental value of Bitcoin, it would be 1 second, right? 0. You don't need KGW, right? You just, everything 0, 0, 0, 0, 0, price per share 0, right? Assignment, 100%, right? Yeah. So what I'm trying to teach you is, in practice, in theory and in practice, does hold over the long term. Share prices do eventually converge to their fundamental value. When they're not, when they're very different from fundamental value, and if they're substantially above, that's a bubble. If they're substantially below, could be a buy opportunity to pick up for you to buy an asset for cheap, right? And that's when you generally get a buy recommendation. When an analyst values a company, the valuation price is here, the valuation price is here, the market price is here, and the difference substantial enough, you're more likely to offer a buy recommendation on that stock. But short term and middle term, and over the short term, and also not just the short term, also the middle term, the medium term, there is an interplay that we have between value and expectations that do matter for stock returns, that have nothing to do, absolutely nothing to do with fundamental value. And what this slide is trying to tell you is that we've got 2 worlds, if you like. One world is the world we as analysts focus on, fundamental value, cost of goods sold, ROIC, WACC, all the things that you've been focusing on in this course. And the second world is the stock market. And in the stock market, fundamental value is important, but it is not the only factor. We have to think about the other factors as well. And that's what this this lecture is trying to sort of tell you. So in the stock market, in this other world that we as analysts, it's a lot harder to incorporate the stock market expectations, predictions about this, speculation, all those different things. It's a lot harder to incorporate. I mean, valuation is tough enough. I think you agree with me. This is even harder, right? So don't worry, there's no assignment on it anymore, but it is not easy, and it is important to your recommendation whether your client should be buying, holding, or selling the stock. Stock prices are, while there's a link to fundamental value, are ultimately based on expectations of the future. So if you as an analyst have the same expectations as your average investor or your average analyst, then and it's reflected in the stock price, then your value per share and the stock price will be very similar. Right? But it is not enough, as it says there, to simply identify good companies and say, oh, this is a good company, Amazon, or this is a good company, JB Hi-Fi, you should buy that. It's not enough. There could be other things going on. A clear example of this is, imagine you have a company that loses a bunch of money. Let's say it loses 20%, huge loss, and the stock price still goes up. Happens all the time. The reason why that happens is when a company announces a huge loss and the stock price still goes up as a result of the announcement, the market was expecting a bigger loss. So the company still lost money, which is not good. It means it's not sustainable over the long term. But if it loses less than expected, stock prices go up. Which means we cannot ignore this. It's in chapter 4 in your textbook. It's called the expectations treadmill. Basically, what a CEO or CFO should do is manage expectations. And companies do this quite well. They sort of report on what they expect, and JB Hi-Fi does it as well in their annual presentation. That I showed you for 2018, every time the company finishes the financial year and reports on the results, it has a presentation, and in that presentation they sort of tell you what they expect next year. That's them trying to manage expectations, so that if the company then, at the end of the 2019 financial year, reports its results, and it's very different to what the market or the investors expect, there would be a huge fluctuation in the share price, which generally is not very good. By reporting on what the management, the people who are most informed about the company's performance, by informing the marketplace what they expect next year, they're trying to reduce this expectations treadmill. The problem especially has been reported on quite well around the world, is CFOs and CEOs are paid in stock, which means they have an interest to increase the share price as much as possible. So a big problem happens, and this was the case of Enron, where managers are just incentivized to continue announcing positive information about the company being great and doing all these wonderful projects, pushing the stock price up. And then when they when they stop being CEO, they sell they exercise all their options, exit, and then the new CEO is like, this doesn't look right. Like, this company is not doing well, right? And then they have to announce that the company, this is what the actual outlook of the company is, and then the stock price tanks, right? So that's not good. So managing these expectations, companies have improved a lot over the last sort of 20 years since the scandals of the early 2000s. Enron, Tyco, Global Crossings, HIH, OneTel, all these companies had management team that was saying, oh, the company's great, it's the best, they're doing such great margin, profit growth, huge, blah, blah, blah. And then all of them failed. And that's because they wanted to keep the stock price going up, not because of fundamental performance, but because they knew that the market, the stock price, if you like, another way of thinking about the stock price, it's a sum of all the expectations about the future performance of the company. And when you pump it up with positive news, eventually, when the earnings are realized, the company will always underperform. So it's dangerous. This expectations treadmill that the textbook talks about is about the CEO trying to manage those expectations instead of announcing very positive, expectations for the future that are just unrealistic. But for us as analysts, it is not good enough to just look at this and say, oh, this is a good company, because that information might already be included in the stock price, right? So if I was to value Amazon, and I love the company, it's a great idea, great business model, blah, 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 the stock price is already high. Just because I've identified a good company doesn't mean I should have a buy recommendation, right? And I'll give you a better example. We're talking about fundamental value, rational valuation, based on earnings and predictions of the future. Markets also work on emotion, right? Huge part of it. Clear example is Commonwealth Bank. I mean, the company I already mentioned today. If you go to, let's have a look, Google Finance. Let me give you I can't spell. Let me give you a very clear example here. Commonwealth Bank of Australia, Australia's largest retail bank. It was doing quite well, growth, blah, 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 and boom, right? 2000, so there was a correction at the end of 2007 when the growth really stopped, and then financial crisis happened here. Right? This is Commonwealth, the financial crisis that hopefully we'll have time to go to the presentation today, really started in US housing for the simple reason that people who shouldn't have gotten loans to buy a house got loans because nobody checked, nobody verified. So these were referred to as subprime mortgages. They were packaged in products called CDOs and sold all over the world. Now, when banks did this in the US largely, in Europe a little bit as well, but mostly in the US, it took about a month to package these mortgages and sell them off. So a month was all it takes. If the bank has a lot of these subprime mortgages that turn worthless in a couple of weeks, they're left with a lot of toxic assets they cannot sell and nobody wants to buy. And because banks are highly leveraged, they go bust, right? And banks all over the world, including here in Australia, took a huge hit. People were saying, oh, the banking model's dead. My question to you is, how much subprime debt did CBA have? Zero. Nothing. Commonwealth Bank of Australia, none of the 4 banks did in Australia, because we actually have more regulations than in the US, which is a good thing. They didn't have any subprime mortgages. They didn't write any credit default swaps. They didn't do any subprime lending whatsoever. But then why were they hurt like all the other banks around the world, especially in the US? Because they were banks. There was no fundamental reason why this should have happened, but it did. The reason why was emotion. Investors were highly pessimistic about banks all over the world, and they stopped caring, they stopped looking at whether or not the bank they were selling had any subprime mortgages. They just didn't care. You're a bank, sell. That's irrational behavior. There was no reason for that. It was just fear, right? And people trying to move their money out and move into cash and treasuries. That is a clear departure from fundamental value. The bank recovered, of course, but it was a clear example of something that shouldn't have happened because simply, in the short run, there was a departure from fundamental value. Another example is HSBC. The Hong Kong Shanghai Banking Corporation is a fascinating company. It's also fascinating from the fact that it has dual listing. It's listed both in Hong Kong and London, right, in both exchanges. And there's a ratio that says, oh, if you own this much in Hong Kong, that means there's a split, basically, between the shareholding. Some shares are traded in the UK, and some shares are traded in Hong Kong. And there's a ratio that makes arbitrage impossible, basically. Otherwise, if there was mispricing, because different currency, right, different number of shares, so in order to prevent any arbitrage of like buying in UK and selling in Hong Kong at the same time, there's a ratio that relates to ownership and splits the company up correctly because it's not 50-50. What happened in the financial crisis was there was a lot more pessimism in the UK about banks, so that ratio got broken. So you actually could do straight up arbitrage where you would be buying HSBC shares in the UK and selling them in Hong Kong It's the same company, same underlying assets. There was no risk. You needed I don't know if it was self-funding, so technically it's not arbitrage if it's not self-funding, but you could make essentially a riskless profit by doing that. That's impossible. Shouldn't happen. It's the same company, same risk, same assets, same industry, but it didn't hold that ratio of the UK ownership relating to the Hong Kong ownership. Again, nothing to do with fundamental value, everything to do with this inefficiency, these emotions that can rule. So we as analysts cannot be ignorant of that. We cannot just say, oh, that's too complicated, or it's too subjective, or we just focus on fundamental value and everything else is not important. That's lazy. We cannot do that. It would be nice if we could. It would be very convenient if we could just say, oh, that's the stock market, we focus on the fundamental value. We cannot be ignorant to that. So the implications for valuation is that share prices do follow this intrinsic, underlying, fundamentally, it all means the same thing, value, but over the short and medium term, they can be volatile and depart from fundamental value. Right? And what the company managers should do is focus on creating value for shareholders and not be distracted by the share price fluctuations. But of course they are, because a lot of their money, what they get paid, the way managers are paid is they get a cash figure, let's say $1 million, and everything else is usually in options. So, and that amount is not small, 10 million, 15 million, easy, right? So of course, what are you going to focus on, the 15 million or the 1 million? Yeah. So you're going to focus on the 15 million and you're going to be looking at the share price constantly. That's not good. Goldman Sachs famously has the share price in their elevator, right? In Manhattan, when you go to the Goldman Sachs building, I've never been, but if you go into the elevator, into the building, it has the share price in the elevator. To me, that's a bad sign, but I don't work there, so I don't know, maybe I'm too boring. But managers should focus on managing expectations and creating this intrinsic fundamental value and not caring about stock prices or emotion, even though they do, and it makes sense why they do. They get paid largely in stock. So my opinion on this sort of these emotions and this expectations game that gets played in the stock market, nothing to do with fundamental value, is that we cannot do anything about that as analysts. All we can do is focus on our valuation, and the valuations do not tell us what happens next year or next day or tomorrow, what the stock price should be right now. I like to think of it as more of a balance of risk valuation, where if you have a valuation that's up here and the stock price that's down here, the valuation is towards the upside. You're more likely than not for the stock price to make money. And if the difference gets bigger and bigger and bigger, your margin for error or your balance of risk is more towards the upside than being even. So what you're looking for as an analyst, what I looked for, was companies that did have a substantial difference between my valuation that I did and the stock price. What I always wrote in my reports is I don't recommend the stock price to be this. This is just a target. I talked more about a range. And if there was a situation where you had a stock that appeared cheap with respect to your DCF, the risk skew, if you like, was towards the upside. And then I would talk about the margin for error. How many things had to go wrong in my assumptions, in my DCF or ratios, before the valuation slowly decreased, was same as the stock price, and then started decreasing. Instead of just saying, I did this, this, and this, my valuation is 20, the current stock price is 15, buy. That's not good enough, in my opinion, right? Because again, my valuation is based on assumptions. I think you would all agree from assignment number 1 and now assignment number 2 that those assumptions are subjective, right? They're open to interpretation. So instead of talking about this is what the price should be, I always talked about the risks, the skew of my valuation is towards the upside, so that's like a buy opportunity. And this valuation that I did for this company relative to the current share price has a large margin for error. A lot of things can go wrong before you start losing money. And I think clients are interested in that. They're interested because they know the methods that you're using. They know they're going to be wrong, not the methods, but your assumptions. And what you want is a buffer, a cushion, before your valuation becomes so wrong that they start losing money. And if you have a large cushion, a lot of sort of difference between the valuation and the current share price, then you have quite a large margin for error. And this is sort of, I talked about this last week with sensitivity and scenario. Those two approaches allow you to calculate a specific number by changing key inputs. They allow you to calculate a specific number for this margin, if it's large or small. If it's small, not good. If it's large, you're more likely to give a buy recommendation on the stock. And this fundamental value does work. It does work. It works on average and over time. And again, as an analyst, you don't value one company like we do, JB Hi-Fi. You value sort of 10, 15, 20 companies. That's your job. And the valuation that you're doing, the target price, is not for where the stock price should be or will be tomorrow. You don't know. It's a timing issue. You have no specific date that you can give your clients to say the stock price for JB Hi-Fi should be at $31 in 1 year's time. You cannot do that. So don't. Yeah. The fundamental value is the best thing you can do, and it does work. But there's no guarantees for individual investments. It's all subjective, and it is prone to error. But if you do it, if you follow a fundamental valuation strategy as an investor even for your portfolio, you will make money. How much, I cannot tell you. When, I cannot tell you, but you will. I wish I had those answers, right? If I had those answers, then I wouldn't be here. I would be behind my desk trading stocks all the time if I knew exact timings, if I knew how much, when, right? My time would be much better spent, instead of working for ANU for a fixed salary, trading from home, right? But yeah, I can't see the future, right? So we're just left with this fundamental value, and all the analysts are in the same place. They cannot specifically tell you when the stock price will go up to JB Hi-Fi stock will go up to 31, when, how quickly, what frequency, when to buy exactly, when to sell exactly. Everything is sort of on average and over time, which are not specific numbers. But that doesn't mean valuation is, it's not an exact exercise. We know it's not. It's subject to assumptions that we have to make, which are subjective. What I want to talk about today, though, is some of these adjustments, these valuations that we can do for these companies, either DCFP, EVM, whatever, sometimes require a specific catalyst, a specific point that will shift expectations of the market back to fundamental value. And this is the power of assignment number 1 and 2 of these methods. When there is a change, either regulation, financial crisis, CEO is drunk, I don't know, whatever, CEO, Elon Musk is smoking marijuana on TV. What is he doing? It's very unprofessional. He's making me look bad, right? He's a good CEO, but do not smoke marijuana on TV. Yeah, if you're a CEO, just to listen for the future. If you guys are running companies, Elon is, he's too arrogant, right? So sometimes, when there is a change, investors, and again, could be a financial crisis, could be something crazy, could be a regulation, could be government, could be Trump gets elected, whatever it is, some change, the market always shifts back to fundamental value. Always. That's why Bitcoin price will one day be zero. I'm not saying digital currency is a bad idea. It's a great idea. But it needs regulation, it needs transparency, it needs oversight. Bitcoin has none of that. So it may be called something else, Bitcoin 2.0 or something like that. I think digital currency does have a place. And like I said in the beginning of this course, I think blockchain is a revolutionary idea. But without fundamental reform, the Bitcoin fundamental value will still stay at zero. That's why I told you not to buy that crap. But you can do whatever you want. So it's these sort of shifting points in the market that we should look out for. I'll give you an example of Boral here. Boral is a very famous company. They've been doing really well. All construction companies in Australia have been doing well, and in fact around the world. The reason is simple: low interest rates. When interest rates are low, all infrastructure companies do well because funding is available. Infrastructure and construction is largely dependent on credit. If there is a lot of it, a lot of cheap money around, all building companies do well. It doesn't matter who you are. As long as you are a reasonable company, you do well. So Boral, BLD, is the ASX code. Fascinating company. Let's have a look. Yeah, so doing quite well, especially over the last couple of years. Stock price keeps going up. Is a construction business here in Australia. They do a lot of concrete manufacturing, lime, concrete products, cinder blocks, bricks, brick products, pavers. They do a lot of materials that you need for construction. The company wasn't doing so well, always. So we have this slide here. As you can see, the company is not new. What we have here is a chart. So here on the left-hand side, I have the return of the stock. Return of the stock here on the left-hand side, scaled, divided by the ASX 200 index return. So it's basically, I'm trying to measure abnormal returns, and I started at 1. So I sort of standardized this index to be 1. And as you can see, the returns of Boral divided by the returns of the ASX market, Boral underperformed early on here in 99. The reason why I did that was we had a housing cycle shrunk. Basically, the housing boom that we had started in Australia in 95, I think. It ended around 99, 2000. It was the bottom of the housing cycle here in Australia. The level of competition in the industry started decreasing, and only the strong players survived. So there was a reduction in capacity. So in other words, there was a structural shift in the industry, a change, the catalyst that I was talking about. And then everything went to fundamental value. Again, people started focusing, oh, what is the fundamental value? What are the cash flows of these companies? The companies that were crap failed. Huge reduction in competition in the industry. And Boral was one of the few surviving companies now in an industry with less competition that actually had positive cash flows, and the company starting performing well relative to the index. So these are not actual returns, these are abnormal returns, which is what you want to measure. And here, as I say, so sort of a relative return of 2.2 means the company did more than twice as good versus the market portfolio return. And remember, this was just before the IT crash, right? So even then, the market was doing quite well, and Boral was just killing it. They were doing really, really well, good business, because there was a structural shift in capacity. There was a huge reduction in competition. And this is my problem with the current stock market today. We have an environment in which we have very low interest rates. Everybody's buying and selling each other. There's a lot of M&A activity, and it looks good. All this money flying around, buying this, buying that. Oh, great deal, good deal, awesome. If the expansion is to increases capacity, you cannot get away from supply and demand. Supply curve increases, equilibrium prices go down, your revenue goes down as a company. You cannot escape that. There's no company in the world I can think of, other than pharmaceutical companies really, that go away from supply and demand. If the growth that we currently have is expanding capacity, which it is, it's dangerous, very dangerous. It's easy to get lost in the M&A and, oh, market is doing so well, this company's buying this company, oh, they're going to be combined, they're going to be a great company, they're going to change the world, right? If they're combining to increase capacity, not good, right? So what happened here was the reverse. So the cycle ended. Investors started looking at, hold on, which companies are actually generating cash flow and growing? Boral was one. A lot of other companies weren't. They failed. Capacity decreased, and Boral was the remaining survivor. There were other players as well, ABC being another. So, and here we have the PE ratio, same sort of exact time scale. We have a low PE of in the 9s, so it looks cheap. So a 9 is you're paying $9 per $1 of cash flow, so you get your money back in 9 years. So anything sort of below 10 is cheap, appears cheap. So we've got 8 and 9 here. Then this reduction in capacity shoots up back to something reasonable. Then we have an IT crisis, so all the companies get hit. And then we have a growth fueled by, again, cheap credit and the desire to expand. So P ratios support this sort of chart where the adjustment in value, the fundamental value of the company was always there, but it required a catalyst, something to change. And what changed in this example was a structural shift in the industry. With JB Hi-Fi's case, what we have here is a mature company in a highly competitive industry. They've admitted by their actions that the only way they can grow quicker is by buying somebody. While buying something, acquiring a competitor may sound sexy, it's dangerous. Right? So what I would expect in something like the retail industry, especially in a country like Australia where retail is very expensive, is to continue to have this reduction of growth in retail. And because it's cyclical, if you have a huge correction in the stock market that has a flow-on effect correction of credit, retailers are not going to do well. So the shifting catalyst that I would expect for a company like JB Hi-Fi would be an economic downturn. And there is a chance that we're close to that. We've been growing for 10 years. Money is cheap. Interest rates are at JB Hi-Fi is borrowing at 3%, which is ridiculous. And in an environment where interest rates are low and debt is cheap, risk is mispriced. Always happens. Risk is always mispriced. And it could be a catalyst like this trade war with China, between US and China. It could be some other catalyst. Oil prices have gone up. I don't know if you've been focusing on that, but oil prices have basically doubled in the last 2 years. They're not at $35 a barrel anymore. I'm sorry? They were at 35. 80 now, right? Yeah, they were at 35 2.5 years ago. Last time I checked, we haven't decarbonized our global economy. Oil is everywhere. It's absolutely everywhere. If oil prices go up, inflation goes up. Oil is in food. We need a lot of oil in food production, a lot of oil in manufacturing, a lot of oil in energy. It's in every single industry. And if oil prices have more than doubled in the last 2 years, which is not a long time, there's going to be inflationary effects, which means the central bank has to move interest rates. It has to move interest rates up at a time when Australian households are the most indebted in the world. It's very dangerous. So it could be some kind of an economic cycle fueled by over-leveraged households that are under stress because the central bank has no choice but to increase interest rates to fight inflation as a result of increasing oil prices. Some catalyst like that. And if I was an analyst and I would be valuing JB Hi-Fi, I would be talking about that in my report. Catalysts that can reduce share prices in retailers, not just JB Hi-Fi. Right? So as analysts, we cannot just look at the fundamental value and how many stores and how many open, how many close, how many in New Zealand, what's the COGS, what's the depreciation, what's the CapEx, if they're home stores or regular stores, if they're online, what's the impact of Amazon. It's not enough. So what can we look at is your question, hopefully. This list is not complete, but it's quite good. There's a lot of, you can go on forever, right, with a list like this, because these are these are qualitative. And with a list like this, you can go on forever. But we only have a short lecture, so 6 is the number I came up with, which is reasonable and are important generally for most stocks. Momentum. There are 2 types of momentum. I'll show you both. Then there's growth, and my sort of perspective of growth. Growth is nice, but also has to be. We have to be careful. Cycles definitely very important for a company like JB Hi-Fi. Themes, I'll talk about that. That gets ignored all the time, which is confronting. Investment flows, very good thing to look at, and also price reactions to news flow. And as you expect, this one, again, these three at the bottom get ignored a lot. And I don't know why. The one I'm talking about here is the news flow, easy to explain. If you have a lot of positive news about a company and the stock price doesn't go up, that means it's kind of run out of steam. That's a sign, by the way. When you have a stock price that's gone up a lot, and then positive news still keep coming out about the company. Great management, good idea, M&A coming up, a number of stores opening, great, blah blah blah, excellent growth, and the stock price is stuck. That's not good. That means there's only one place to go, right? If all this positive news cannot still move the share price, it is not part of fundamental value. Right? It's already been included in the share price, and now the performance is just catching up with the expectations. Okay, so let's talk about momentum. So momentum is interesting because there's two types. There's earnings momentum and price momentum, share price momentum. So momentum historically has been defined as this anomaly in finance literature. If you Google momentum anomaly in academic journals, you'll find a lot of articles from the 70s and 80s and even 90s, because momentum was a strategy. It used to be a trading strategy where you identify winners, companies that have gone up both either with earnings or with share price, and you keep buying winners and selling losers, right? These days, that strategy is gone, by the way. If you do find any abnormal returns, usually they're eaten away by transaction costs. So your strategy is kind of worthless. And in the GFC, oh man, if you were a lot of momentum funds went bankrupt. A lot of momentum funds went bankrupt. So momentum was a strategy for a long time, and it kind of died in 2008, is what I'm trying to tell you. Momentum funds lost big. And the reason why is not because the strategy just broke down. The strategy stopped making money, but the big problem is that when in a financial crisis, when you have a fund that's reliant on one strategy, and the strategy stops working for 5 minutes, like it is in a financial crisis, everything stops working, everybody wants their money out. Everybody's trying to withdraw money from these funds, and what funds, in order to repay back the investors, the funds have to sell the assets. What's the worst time to sell assets in a crisis? Everything's going down. It's a fire sale, right? And that's what momentum funds, a lot of hedge funds as well, failed in the financial crisis because everybody was redeeming the funds. They invested some money in a fund, they all wanted their money back. And momentum funds had the big problem of selling when prices were going down. And the worse the market went down, the more they had to sell at the lower prices. So they went bankrupt. And momentum hasn't really recovered from the financial crisis because the volatility in financial markets has picked up. Volatility is not the best for momentum funds because momentum funds sort of expect, they allow for volatility, but not large swings. They sort of they can have volatility, but they eventually want the momentum to continue. So winners continue winning as shares, and losers keep losing. And volatility, if there's large volatility, has these huge swings that can actually bankrupt momentum funds. So momentum as a strategy hasn't been seen since the financial crisis. Two types of momentum, earnings and share price. Let's talk about the earnings first. Earnings momentum is something we as analysts do focus on, whether we want to or not, because we look at historical data in effort to help us predict future performance in terms of revenue and profit. So if we see a company that's been growing for a long time, steady growth, whatever, a large growth, that has, whether we like it or not, has an impact on our prediction. So if we are valuing if you are looking at historical returns, which I told you should not do as an analyst, but analysts still look at how the company has performed historically, and we see positive growth, we're looking at momentum. That's what momentum is. We plug our numbers into KGW. We look at JB Hi-Fi or whatever company we're valuing. For those 10 years, we see positive growth. For the 10 years, top 5% growth, 4, 3, 2, 12, whatever it is, we're looking at momentum. It keeps going up. You have to be careful, just like with anything, with valuation. First of all, momentum, surprises may signal, if there is a change in momentum, a surprise may signal that there is a revision and that there is a trend that's starting. Historically, by trend, it doesn't have to be a year. We look at yearly data in this course. If I was in the industry, I wouldn't be looking at yearly data. I would be looking at 6-monthly data. In the US, I would be looking at quarterly data because companies in the US report every 3 months. In Australia, every 6 months. These earnings momentum is what I'm trying to tell you. You have to look at it from a short-term perspective, not like what we did in this course, annual frequency. KGW only allows for annual frequency, so that's what we did. But earnings momentum can be at the short-term level as well. Let's look at Coca-Cola on the other slide. When you sort of identify this momentum either over quarterly or semi-annual or an annual frequency, you shouldn't just accept it. You should, of course, investigate, ask the question why. I know it's inconvenient and it takes time, but it's very important. This is your job. This is what you're paid for as an analyst, to ask and answer these questions. Is it a one-off change? There's this change of the company's been losing and now it's going to be increasing, or the company's been increasing and now it's going to be losing. If it's a one-off, then ignore it. But if it's not a one-off, then it's a sign, again, there's some kind of a shift. The ground is shifting. It's not a one-off occurrence. And that a trend could be starting for 3, 6, 12, whatever months. So on the slide here, I have Coke. So Coca-Cola. What we have here is a fascinating company. This is Coca-Cola in Australia. It's not the American Coca-Cola. So it's Coca-Cola Amatil, not Coca-Cola in the US. What we have here is earnings momentum. Right? So we have clear signs of increasing earnings. Right, for a number of years, a couple of years, so semi-annual frequency, remember, in Australia, doing quite well. And then we've got a revision. The analyst would look at that revision, a huge drop, first of all, a negative result, a downward revision in earnings. The analyst would ask him or herself, is this a one-off or is this a trend? In Coca-Cola's case, this was a trend. The momentum was for what, like a year, something like that? And then it switched again, your positive momentum here for whatever it was, a year and a half. And then again, another revision, a downward revision in momentum. I think the company made some bad investments. No, this is financial crisis? No, this is before. So bad investments, whatever it is, went down and then kept going up again. And this is earnings. And earnings kept going up during the financial crisis. Right? Again, this is not share price momentum. This is earnings per share. The company was fine. It's a healthy company. So what this was telling me is if the stock price was decreasing, which I assume it was because all the stock prices were decreasing in the financial crisis, I shouldn't have been selling the stock. If anything, I should be buying the stock because earnings momentum earnings continue to increase. If there's a fundamental reason the company has made good investments, has great projects, supply and demand looking good, there's continual demand for the products, then I should be looking at earnings momentum as well to see if I can identify a trend, and I should not care that the stock price is going down. It's going down not because of fundamental value, obviously. It's going down because everything's going down and people are panicking on the stock market. That's an opportunity to buy, not sell. That's what Warren Buffett does. This is all what Buffett does. This is how he got famous. He is buying when everybody else is selling and making sure he's not making silly mistakes by looking at earnings, the company's ability to generate cash flow in the future. And if it's healthy, if it's not impacted adversely in terms of fundamental value, then if all the stock prices are going down, that's an opportunity to buy something for cheap. Right? So earnings momentum is something to look at, and if there is a sustainable reason why the earnings have shifted from going down to going up or the other way around, you should recognize that in your recommendation. And if it supports your view, so if I was here, for example, and I did a valuation, the price was, my valuation was here, and the price per share were here, this would support my recommendation to buy the stock. So momentum is something that can support your recommendation or go against your recommendation and should not be ignored because it reflects fundamental value, something the company can generate. It's all about cash flow. This is why Bitcoin is worthless. There is no cash flow. If there was cash flow, I wouldn't say anything. But there's no cash flow, it's worthless. And stocks, there is actual companies, hopefully good companies with good management, behind the stock. There's nothing behind Bitcoin, it's just a price. It's meaningless. Right? It's just price that you have to pay if you wanted to buy it. But you're not buying anything. You're not buying a piece of the company, you're not buying a piece of the assets, you're not buying dividends, you're not buying anything. You're just buying air, which is not good. So earnings momentum is something to look at to see if it's a one-off or a trend. If it's a trend, pay attention. Pay attention. The other type of momentum is share price momentum, and this is where these funds went wrong. They didn't really focus on this. This is too complicated for them. They just look at the stock price, right? And this is kind of where, again, Bitcoin is the perfect example. The price kept going up, and people got excited about the price going up. Oh my God, look at the momentum. It just keeps going up and up and up and up in 2016. And a little bit of 17, and then by the middle of 2017, the party was over, right? So, and then there was a huge correction, and I suspect the coin will still go down further. But price momentum is not earnings momentum. It's not fundamental in nature. It's just looking at the share price. The strategy that these funds, they were using a lot of strategies, but the most common strategy was annual momentum. So 12 months momentum leads to 6 to 9 months outperformance. So if you test this historically using actual data going all the way back to 1910, whatever it is, as much data as you can, if you define momentum on a 12-month basis and you identify a winner, you should buy that and hold it for 6 to 9 months and then sell it. That was the strategy. That was the momentum strategy a lot of these guys were operating. The reason why it's only 6 to 12 months is because fundamental value. Stock prices always come back to fundamental value. They have mean reversion. They revert over time back to their fundamental prices. This momentum thing is a temporary occurrence, a temporary bubble, if you like. You can call it a bubble, you can call it something else, call it whatever you like, but these prices always return back to fundamental value, which is why, as analysts, that's what we obsess over. It may be a disconnect in 6, 12, even 12 months, a disconnect between the value and the stock price, but in the end, overall, the stock price does come back to the valuation that you're making as an analyst. Right? So think of this momentum like a short-term sort of strategy that worked for a long time until the financial crisis, but over the long term, medium term, the value investor, the fundamental valuations, as opposed to the momentum investor, outperforms. And you can test this using data if you like. There's plenty of papers. Again, go to Google Scholar, type in share price momentum. You'll get a lot of papers, many of them old. Yeah, many of them from the 90s, 80s, 70s. These days, this doesn't exist anymore. So you can try, it's your money, but don't. Yeah. Yeah. So that's momentum. There's two types, and in my opinion, you should pay as an analyst more attention to this. This is actually important. When some analysts talk about momentum, sometimes they mean price momentum, and by all means, look at the share price, look what it's doing, but please don't design your valuation or your recommendation based on share price momentum. Yeah. If anything, that's what you want to use to discourage, right? Because you might get a question from a client, oh, I've looked at the stock price, it's been increasing over the last 12 months. It's a good time to buy, right? Well, talk to them about momentum, that no, stock prices come back to fundamental value. I did a fundamental valuation for this stock. This is what I got. This momentum is a temporary effect that will eventually end, and the stock price will come back to this fundamental value, which is $31 a share for JB Hi-Fi, or whatever your valuation is. Right? So if the client wants to talk about it, you can talk about it, but I always saw this as a warning sign. Yeah. Yeah. But earnings momentum, sure. Yeah. If it's not a one-off, it's definitely something you should pay attention to. Any questions on that momentum? So two types. Yep. Yeah. Yeah, it's very good. Yeah, it's a very good question. So for those listening, can share price momentum be created? The answer to that question is yes. It's a great question. It's a fascinating question as well. There are especially large clients, especially large investors who can actually move markets. Warren Buffett is one example. If Warren Buffett goes on Bloomberg or CNBC on television and says, I bought stocks in Tesla, the price will go up 20%. And nothing will happen. The company doesn't have to report on the cars they manufactured. Elon Musk stops smoking. Nothing has to change. If Warren Buffett stands up and says, I bought Tesla and I bought this much, 5 billion or whatever, in Tesla stock, the stock price will go up further after he bought it, 20%, easy. If you are a hedge fund kind of person, you don't have to be a Warren Buffett. Einhorn is an example. Einhorn is a fascinating person. That's Greenlight Capital, I think it is. There are a few hedge fund managers who are so well respected that their opinion matters. And they're also, it's not just their opinion, it's also their funds are quite large. So if you're trading a stock in a very small company that's illiquid, it's very easy for a person with, $55 billion in funds to buy a large portion, and then and that moved the share price. It's easy to move a share price of a small company. Even JB Hi-Fi, medium-sized business, for a person like Einhorn or Buffett, is a small company. It's very easy for them to buy large volumes of that stock and move it up. And then say, oh, this company is great. It's a great company. It's going to do well in the future. The Good Guys acquisition is awesome. And that moves the share price even further because other people will jump on board and respect those individuals, and it creates share price momentum. So momentum can be created. It's, of course, nice to buy before they announce what they did. It's hard to, they don't share that information. That's private, of course. That's how they get paid. So I can think of sort of 20, 30 people, most of them in the US, I suspect. In China also has a lot of big fund managers and wealthy individuals who can move stock prices. So it's not just an American thing, it's a global thing. In Australia, I can't think of too many. I mean, we don't really have these large fund managers here because our stock market is much smaller than China or US or even Europe. Yeah, you can create it. As an analyst, you would have to look at the specific numbers, but you would be hesitant in recommending to buy just because Warren Buffett would. If you could figure out that he's going to buy it and recommend, buy it now before the announcement, then yeah, of course you do that. You make 20% in one day. You would want to do that. You probably do that yourself, right? You don't tell your clients because if it's wrong, they'll sue you. But yeah, momentum can be created. With large stocks, it's much harder. Even for a person like Buffett, if it's a large stock, ExxonMobil, Apple, GE Electric is a small stock now, Morgan Stanley, Goldman Sachs, Bank of America, Pfizer, Merck, these large companies, momentum is harder to create because there's just so many shares. You have to buy so much, tens of billions of dollars. But for smaller companies, yeah, it can be created. Don't fall for the trap, though, because it could be a strategy. I think it's illegal now, but in the past, what would happen is a manager would buy a large stake, not tell anybody, finish buying, announce that this is the greatest company since IBM. The stock price would go up, and then he or she would sell, and then cha-ching, right? And then you lose money, right? We sort of saw that with Bitcoin, right? I remember 2-3 years ago, Bitcoin is going to revolutionize the world. It's the greatest thing since the internet. It's completely, it's awesome. It's a digital currency, easy exchange of capital. It's unregulated, all these wonderful things. And the people who made money are the exchanges, the Bitcoin exchanges. They made a lot of money because everybody started being interested in Bitcoin. And the spread, the bid-ask spread, the transaction costs for Bitcoin are huge. 25%, easily. So the market makers, the actual exchanges, they made incredible amount of money buying and selling Bitcoin because they're specialists. They're called market makers. They're both buying and selling Bitcoin. So if you want to sell to them, they'll say, okay, but 20% below the current price. And if you want to buy from, okay, but 5% or 10% above the current price. If you want to buy such large amount of Bitcoin, and they make the difference. They make the fee. So they did really well, selling garbage, worthless assets. And it's not just Bitcoin, it's all of them. Ripple, Ethereum, Tron, they're all worthless, right? And the people who win are the exchanges of these Bitcoin, of these digital currencies. They make incredible fees, billions and billions of dollars. It's a great question though. Momentum can be created, and your job as an analyst is not to recommend a stock that has this momentum artificially created, because it's not sustainable. Everything comes back to fundamental value. It does. That's why this course exists. What I'm teaching you, the methods, apply to all other companies and have a big bearing on your recommendation. And usually when there's some sort of structural shift, it all comes back to this fundamental value, which is important. Okay, so growth. So you know my opinion on this. Growth is nice. It's very nice. It's nice to grow. It's nice to value a company that grows. It's nice to talk about growth. Investors love growth. They want to hear growth this, growth that, growth this, right? Yeah, growth is nice because the alternative is negative growth, right, which is bad. The problem is not with, my problem is not with positive growth. My problem is with unrealistic positive growth expectations and predictions that analysts make. So obviously negative growth is bad, companies shrinking both in sales or market value, whatever it is. And to value a company that has positive growth is what you want to do as an analyst when you want to buy a recommendation on the stock. But my recommendation to you is don't go crazy. This is why I told you in the class with JB Hi-Fi, if you're giving me predictions for revenue of 10% for 2019, you're crazy. A mature company that operates in a highly competitive industry that has substitutes. I don't have to buy my television from JB Hi-Fi. I can buy it online. I don't have to buy my iPhone or my iPad from JB Hi-Fi. I can go to the Apple store. They're in the same shopping center, right? It's like a 2-minute walk from JB Hi-Fi to Apple. Right? I don't have to buy DVDs in the store. I can buy it all online for less. And I can download it, and it's more convenient. And I can watch it whenever I want. JB Hi-Fi is not a company that I have to use to buy my electronics. With a company like that, highly competitive, in a highly competitive industry, mature, and is prone to substitutes, so I don't have to go through JB Hi-Fi, will not grow at 10%. It just won't. That's why they did the acquisition. Acquisitions, the inorganic growth, as I said in the lecture on growth a couple of weeks ago, is an admission, can be most of the time, it's an admission that the company cannot grow organically. M&A can be very dangerous. So what it says here is the stock market is not always good at distinguishing true growth potential to create shareholder value, which is what we're interested in as analysts, from mere top-line growth prospects. Top line means top of the income statement, the revenue, right? And again, they focus on revenue. And what I've hopefully tried to tell you is revenue is irrelevant, NOPLAT, or EBITDA, or operating profit, or the operating margin. That's what matters. If you just focus on revenue and say, oh, the revenue grew at 10, 15%, it's a good company. No, my question is, what is the profit growth and what is the profit margin? That's more important. And the third one we have in bare bones as well, the capital turnover, the efficiency ratio, sales divided by invested capital, right? So that's very important. That's what you should be looking at. Not just one number. If you just look at this number that's looking at top line growth, that's not enough. You can have companies, 12%, 15%, 20%, looks very good, right? Juicy return, juicy increase in growth of sales or revenue. 20% growth in revenue is very good, but it's meaningless. It's absolutely meaningless. It has to be looked at with respect to how efficient the company is, how much profit they can make per sale, and how expensive they are to fund. Those four have to be looked at once, at the same time, not just looking at this number and saying, wow, 12% growth is very good. All four have to be looked at by an analyst together. Yeah. So that's my problem with growth, that it's just everybody focuses on this line here. And that's it. And everything else is not important. Not good. Not good. All of those four are very important, and they have to be looked at the same time. So when you as an analyst, you see a company that has high growth, and you're like, ooh, looks like a good recommendation for my clients to buy. Slow down. Slow down, please. And remember me, hopefully. And remember this slide. And say, well, okay, Joseph said high growth is good. Yeah, high growth is good. But what about the other aspects that have to also exist for you to identify a valuable / good company that your clients can invest in? Other things you look at, ROIC. Right? Or marginal ROIC. Marginal ROIC is, or RONIC, marginal ROIC, RONIC, same thing, is the ROIC that the company can earn if it was to invest $1 today. So if it was to invest, so not existing assets, if it was to invest $1 today, what would be the return on that $1? So they didn't make the investment, but if they wanted to make an investment, what sort of return can that investment make? So what this is asking for really is trying to answer, trying to answer is, does the company have access to positive NPV projects? And if the answer is yes, good. The growth makes sense. The company is investing in positive NPV projects. It should have the high ROIC. It should be doing that continuously. So historically, and your prediction should show a high ROIC. But also, going forward, does the company have a plan to grow in the future? And if so, what it is, and how profitable are these projects? A lot of the time, you will not have this data, but you can interpret what the company is trying to do with the cash flow, where they're investing their money. Right? Another thing, not just looking at growth, so not all four of them. One of them is enough. One of these four lists is what should be present with the growth. So you don't have to, the more you have of these, the better, obviously. But you should look at growth, and the company you're going to recommend to buy should have at least one of these four stories. So the first story is a return story. The company is able to invest or has already invested in positive NPV projects, which is reflected by a good return. Next, it's an expansion story. Is the expansion cheap or is it expensive? Is it low capex? If the company is growing, generally the growth is not free. They have to spend money. Is the money they're spending a lot or a little, or the average of the industry? And if it's if it's cheap capex, if it's cheap to expand, that's good. You don't have a lot of companies that can do this, right? eBay, Amazon can do that. Yeah. So if you have companies like that, they can grow. They of course have to spend money to grow, and if that spending, the capital expenditure, is cheap, that's good. Yeah. Another one that can be true is the industry. Is it a solid industry structure with where there is a sustainable competitive advantage for the company you're valuing, or is it easy for a competitor to come in? Right? In the case of JB Hi-Fi, this is not true. It's very easy for a competitor to come in. Right? It doesn't have a solid industry structure. Right? If you have an insurance company or a bank, it's not easy to get a license to be a bank or an insurance company. There's a huge barrier to entry with respect to regulation. Or a pharmaceutical company. It's not easy to start a pharmaceutical company, right? If I start making pills in my garage, I'll probably have policemen in my house the next day. and nobody will buy that. Hopefully, nobody should buy that, right? I'm not qualified for this. You have to be a large, well-established institution with a lot of doctors, a lot of medical professionals to start selling medication. It has to be tested. It has to be approved by the government. It's not easy to enter that industry. So the companies that operate in the pharmaceutical industry, Pfizer, Merck, GSK, these are huge, huge companies, have a massive competitive advantage. They have a very solid industry structure, and they're protected from competition through regulation, right? JB Hi-Fi doesn't have that. And largely, and the third thing is good people. This gets, I've said this before in this class, this doesn't get enough attention. If you have good people running the company, even if they smoke marijuana on TV, that's a good sign. So Elon Musk is very passionate. He should be more professional than he is, that's true. But he's very passionate about the business. A lot of people who start their own businesses, like Steve Jobs, sort of started in the garage, are very passionate and care. And that's a good sign. Should he be more professional? Elon, yes. Right. The SEC settlement, if you're listening to Tesla News, he said he hinted at taking the company private. It's technically market manipulation to try to punish short positions. He shouldn't do it. He shouldn't be. What all the markets have, part of the regulation is what's called continuous disclosure, which means information that is relevant to the valuation should be disclosed immediately. By hinting that he was going to take the company private and he had secured funding to do so, without that funding actually being secured, is market manipulation, which you can go to jail for. It's quite serious. But he reached a settlement of $20 million fine, and he gave up the chairmanship, so he's just now CEO. So if he it doesn't help to do that, but I would still consider Elon to be a capable manager. Right? He's very passionate. He obviously cares. The products are great, but he should be more professional. Nonetheless, I would consider him a capable manager. Examples of capable managers, look, the people running BHP Billiton are very capable, so that's Australia's largest company. People running the Australian banks, as we've seen with the Royal Commission, are not very capable. But the reason why those banks do very well is we have a housing boom in this country, or we did at least, before it ended a couple of months ago. So it's very easy to make money as a bank when the housing is going up. You don't have to do anything. People just come to you and want to borrow money, and you give them money for a fee. And if all of Australia does it, then you make a lot of money. So ANZ announced huge fines today, I think $800 million or something like that. If you're reading the news, the financial news, that's nothing. The company has $7 billion annual profit, I think. So profit, not revenue, profit. So would be in the Canberra Times. So if a company like ANZ, and all the big banks will have fines because they've done the wrong thing. They were deceitful, and they lied. So much news today, it's already gone. Where is the search? Do we have a search? No search? Wow, very good website. If I click on financial, it should be here. Here we go. So ANZ and all the big banks, you know, that's not small. It's a lot of money to you and me, 824 million. That's nothing when you make $7 billion a year. So that's a one-off fine. But that comes down to bad management. There's no, even though these are large companies, right? The big four banks, they're huge. They're very powerful as well. And just because they're big and they're well respected, they have a good brand name, doesn't mean the management's good. The management doesn't know what their people were doing. They were selling crappy advice. They were charging people who were dead. It starts at the top, right? There's a saying in business, the fish stinks from the head down, right? It has to start at the top, and you as a CEO, CFO, CIO are responsible for the day-to-day running of your company. And just because you're well respected, ANZ, what do I know compared to ANZ, it doesn't mean they've got capable managers. Yeah? So some fake examples of this fake growth. A lot of money went into Asia in the mid-90s for these big projects in order to be part of the China story. So the China story, the Chinese tiger, the Asian tiger, so Korea, China, Thailand, Vietnam, these countries that were growing very quickly in the 90s. The West wanted to pour in money to buy assets to capture the growth without really checking where the money was going. That's not good. When you're investing money, you want to know what the projects are, what the details are, what the ROIC is, what the margin is, all that thing. So when you as an analyst are reading about some investment the company is doing or thinking about, and the CEO or CFO is not talking about, he or she is just talking about growth, they're not talking about ROIC or any return measure, ROE, ROA. They're not talking about capital stingy expansion, CapEx, how expensive it is. They're not talking about the industry structure. They're not talking about margin. They're not talking about efficiency. That's a bad sign. That's not good. You need capable management, and if all they do is talk about growth and M&A, not good. Right? So that's what happened in Asia in the 90s. The IT boom was a clear example of bad management, especially on the part of in the financial sector. All these analysts, even equity research analysts, were saying, "Oh, IT, great, new industry, buy." Not good, not good. They didn't check where the money was going or how. Wine in Australia. So there was a huge sort of push to make Australian wines, famous or respected on the world stage. Australian wines are not bad, but they're mid-tier at best. At best. French wines and South American wines are much better. So there was this drive in Australia to make Australian wines premium. They're okay, but they're not that good compared to European and South American wines. So again, there was Foster's is a great example. They started buying wineries all over Australia in order to be part of that growth without actually thinking about, am I going to be able to sell these wines at premium prices? They never asked that question. Not good. Genuine growth stories, Cochlear, great company. ASX code COH, I held it for a while. I sold it too early. The company, as I said in this course, the company continues to do well. It only has one competitor in the world, Advanced Bionics. So they have a duopoly, and the products that Cochlear makes are very good. They had a scandal in 2012 that was very hurtful for the company, but that's the only bad mark I can see. The company is it's well managed. It's run by doctors. That's another important thing. The one reason why I don't respect Apple is because it's not run by an entrepreneur. Steve Jobs was an entrepreneur, right? Apple with and without Steve Jobs is a different company, right? When Steve Jobs left the first time, when he was kicked out by John Scully, the CEO he hired, Apple was facing bankruptcy within 5 years. They created the Newton, which was a horrible product. The Lisa was a disaster. They didn't market it correctly, and they mispriced it. They set the wrong price, and they stopped focusing on the Apple II, which was an old product. IT, you have to update all the time as a company when you produce your computers. So trying to flog an old computer that was sort of up to date 3 years ago and still thinking, oh, this is a new product, and all you did is change the RAM from 8 to 16, that wasn't good enough. And that's what John Scully was the CEO of Pepsi. He was a marketing guy, right? Big changes, Pepsi, if you change the font on your logo, that's what big change is at Pepsi. Pepsi is not a manufacturing company. They outsource that. They are a marketing company. The product they produce is garbage, right? But their job is to convince people that their soft drink or whatever it is great. And they do that very well. But as a product, it's garbage. Right? Water is better. Drink water. Stop drinking soft drinks. It's bad for you. But Pepsi and Coca-Cola do it very well. When you have a company like this, you should pay attention of who's running the company, because when Steve Jobs came back, They started focusing on the products. Apple's core competency is the brand name and the product, the usability of the products. The really magic behind Apple, which is what Steve Jobs focused on, is taking a product that's hard to use and making it accessible from a design perspective to everybody. That's the core, that's the magic in Apple. If my grandmother can use an iPhone, anybody can use an iPhone. So that means the whole world is your client. Maybe you're too young, but before Apple, Nokia and Ericsson were the companies that made phones that people really liked. They were not good products. They were hard to use, they failed, battery was garbage, calls failed, SMS, you had to type everything. They were not good products. That's why Apple defeated them so easily, because they came up with a good product. All right? That's just very expensive. Yeah. I saw the pricing for the XR. The XR Max is $2,400. That's insane. You can get a computer for that. You can get a phone, I guess, these days. Yeah. So, Apple it's all about the product, making it user friendly. Yeah. That's the magic behind Apple. And Steve Jobs focused on that. He made the computer, the desktop computer, accessible to my grandma. She can use the computer. That's how easy it was. You didn't have to be an IT expert or an IT person to use a computer anymore. Anybody can. So your whole world becomes your client, and that's your customer, and that's great. That's a great idea. JB Hi-Fi, I think they've sort of matured in the past. They've started very small in Victoria, a couple of stores, and they've matured and become the dominant retailer in electronics, and they've done very, very well. But now I think the growth is over, in my opinion. eBay, wow. Yeah. That company does not get enough attention. It's one of the greatest companies in the world. The reason is they don't do anything. You don't have to do anything, and you're worth billions and billions of dollars. How awesome is that? All you do is provide a platform for buyers and sellers to find each other. That's all you don't make anything. You don't store anything. There's no inventory. There's no large headcount. There's no large people. There's no factory. There's nothing. It's just a trading platform where buyers and sellers find each other, and then they buy and sell from each other, and they sell directly to. They send the products directly to each other, and they transact directly with each other using PayPal or credit card or something like that. So eBay just provides a website. Genius. Absolutely genius. There's no CapEx other than some IT, some servers in California, nothing too expensive. You need some IT technicians to keep an eye on everything, write some code, algorithms, resolve any conflict, and that's it. That's all you had to do. It's brilliant. It's absolutely brilliant. It's capital stingy, high ROIC, because you take a very small fee from millions of transactions. It's not a solid capital industry structure. There is always competition, so that's not it. And management is very capable. So eBay ticks this box, and this box, yeah? And have good growth. So, yeah. And Apple, sad face. I've talked about that. So a great company from a product perspective, but I think under Tim Cook or anybody else who is not an entrepreneur, the company is not really, it's a different company. And you can think of a product after Steve Jobs died that's revolutionary in Apple. The watch. That's it. That's the only new product. The iPad he thought of, iPhone he thought of, the iPod, which revolutionized the company, he thought of. I can't think of a single product. The iMac was there. The MacBook was there. Name one product other than the watch, which is not good. It's not necessary. The watch is nice, but it's not worth $500, right? I can't think of a single product after Steve Jobs didn't come up with the idea, because all they're doing now is revamping their phones or revamping existing product lines. There's no innovation. The innovation is on the software end and increasing the RAM or the screen size. There's no product innovation. It's just improvement. And that's not enough sustainably. But the company does very well. The iPhone is very good. It's just expensive. I like the iPhone. It's crazy, the price. So that's growth. Don't just look at the revenue. Also look at these other factors. So be wary of acquisitions. I've said this a number of times. In terms of timing investments in stocks, before I get to acquisitions, let's talk about CapEx. When you're timing your investments in stocks, ex-CapEx is better than declared but not exercised CapEx. What that means is when a company is growing, they usually have to spend money. That money is generally not small. Sometimes it is like eBay, but not always. It's usually quite large. You want to start buying. You're more likely to make money or look better for your clients that you're recommending. They follow your recommendation to recommend a stock after it has spent the money. Companies have to spend money to grow. So there's a question of timing here. Should you buy the stock before they start spending or after they start spending? On average, after they stop spending, after they build the factory or whatever it is they're spending money on, invest then. Because declared but not exercised CapEx spending generally is more risky. Companies are very famous for underestimating how much money they have to spend on growth. And when you as an investor buy the stock when the company makes some big announcement about growing, then they start spending the money to achieve that growth. They usually have to spend more or overestimate the growth, and the stock price goes down. You want to buy the stock then, after this money has been spent, to make sure there is no cost overruns or the company doesn't have to spend more than it's expected. So what this is trying to tell you is market wants high growth, right? And the growth comes at a cost. The company has to spend money, but doesn't want to pay. But the market, the investor, doesn't want to pay for it. Well, that's stupid. That's not possible. But one way to help that is by buying after the company spends the money. Because after the company spends the money and builds the factory or expands in China, whatever it is, then the revenue starts coming in, right? So if the spending is small, who cares? But when the spending is not small, and a lot of companies it's not small, then it's better to buy after the spend once the project or whatever the factory is built and starts generating revenue. So the market hungers for a growth story, but it needs CapEx. That's the problem here, right? There's no such thing as free growth. It does cost money. And again, this is where this capital stingy expansion is quite important. If you can identify a company that it expand for cheap, that's good. If you can't, if you're valuing a company that has to spend a lot of money to grow, you're more likely to make your clients, the consumers of your valuation, happier if you recommend to buy after the spending, once the project is online. Yeah? So there's a saying in finance, buy the rumor, sell the fact. So that basically goes down to buy the rumor means when the market is getting excited about future prospects, you should buy, and then sell when the firm attempts to realize the investment. I never really liked that much. It's okay. I see what the saying is trying to say. It's trying to say that it's easy to get lost in the storm. When financial market, when stock market is going up, everybody's making money, M&A this, growth that. You start getting, oh my God, if I don't buy now, I'll lose out. I'll miss out on this opportunity, right? So you buy the rumor. You buy you buy in on the excitement. You buy on the Bitcoin rise. And then when people stop and things start going back to fundamental value, and the company actually has to spend the money, it becomes a lot easier than just getting excited. Getting excited is easy. Actually doing something, the company building a product or building a factory or trying to change something or trying to beat a competitor is hard. It is. It's hard. So if you have this sort of approach that you should recognize that getting excited about something is easy and then actually doing it is much harder. That means that I always had the view that if you're at the start of the excitement, that's good because you have first mover advantage, and then so if you were the first to buy Bitcoin at $1 per Bitcoin, you would have done very well. and then sell it when everybody else starts getting excited about it. But of course, that's difficult. The timing, trying to find exact timing is next to impossible, right? So, but be careful when you're, because on average, not in every company is different, but on average, getting excited is easy. Doing what you get excited about is not easy. And companies, even big companies, large companies, billion-dollar businesses, fail, right? Trying to realize their dream of changing the world with something. Yeah. So a big example here is resource exploration in Australia. We have a huge resource industry in this country. Huge. It's the #1 industry in Australia, energy and resources. I can think of the Woodside Petroleum, which is still around, ASX code WPL, I think. In the 1980s, they found a lot of gas. A lot of gas in the ground. When they made the announcement that they found all this gas and it's worth this much and this many barrels and they're going to ship it to China or Japan. Japan is the big market for Australian companies in gas, and Korea. The stock price went to Pluto, right? The stock price really went up very, very quickly. But that's just getting it's just investors getting excited about the stock. Then the company actually has to spend money to develop the mines and get the gas out and on a boat, or get the coal or iron ore out of the ground and sell it, send it to China or India. That is not cheap. That is usually quite expensive to develop these mines and these projects. So once, of course, the stock price went up when everybody got excited. Then the company started spending money to develop these projects. Stock price went down because the capex was not cheap. And then once the company went ex capex after the spend and the mines were developed, then it started outperforming again. So, and this is quite common in Australia, that resources are great to have as a country, and access to them by companies is very profitable, but it's not cheap to develop these. Whether it's liquefied gas, in the US shale gas, so you need these rigs, and you need hydraulic fracturing is the process that was developed in the 90s to get this, to get oil and gas out of shale, out of rock, which seems crazy, but that's the process, revolutionary technology. You can actually get gas and oil from rock, right, from shale, which revolutionized the energy space over the last sort of 15, 20 years. But it had this sort of cycle. You need to spend money at some point to realize this growth, and that's usually not cheap. So in terms of timing, you as an analyst have to recognize the fact that it's easy to get excited, then to actually do it is expensive, but after the spend, usually there are big benefits for these companies. So that's a good time to recommend the stock, to buy the stock. Casinos in Australia have a long history, I think all over the world, because it's a controversial issue, right? Casinos. In Australia, likewise. So Crown Casino, there's two main types, two main companies here. One of them is Crown. Crown had a very small, crappy casino in the beginning, in the 90s, and they were surprised by how many people wanted to go in and gamble, right? So they had this crappy casino, which was doing really well, and so the company's stock price relative to an index went up went up quickly. And then the company said, ooh, this is nice. We have to build a proper casino, like in Vegas, right? Let's build a big casino for the big fish. It's a whole thing, a hotel, casino, bar, restaurants, everything. It's not expensive. It's not cheap to build a building like that. So they spent a whole bunch of money to build the casino. There were huge cost overruns. It's a great building. If you ever don't gamble, but if you go to Sydney, go to the Crown Casino. It's a great thing. And the new one in Barangaroo, I think there's going to be a new one there. It's going to be very nice, but these buildings are not cheap to develop. So the company started spending money, and of course there were cost overruns. It was very expensive. Capex was very large, so the stock price started going down relative to the index. And then the casino was built, and the stock price went up again, right? Stock price went up again, and ROE and ROIC went up again as well once the invested capital was in place. So again, there is this sort of timing thing with capital expenditure that you should be careful of. That usually with capex, it's not cheap. When it's cheap, nobody cares. But when it's expensive, like with mining or this casino example, it has big impacts on your recommendation to buy, sell the stock. Like I said, acquisitions, look, I like the idea of acquisitions. It makes sense to me. I get excited as much as everybody else, but they're risky. 60% of the time, acquisition loses money. 60%, not 50, not 40, 60. 60% on average, right? Destroy the acquirer as well. The target shareholders always win. The acquirer, the target shareholders in an M&A always win. On average, 20 to 30%. They're fine. They're doing great. If you're a target shareholder in a company that's going through an M&A, you're happy. You're very happy. Your stock price just went up 30% in one day, right? I think there's an acquisition announced today, right? MYOB. I think KKR is buying it out. MYOB. So KKR is buying it. That's the venture capital fund. 20% in one day. In not even one day, like 1 hour. It's nice, right? It's nice to be a shareholder in MYOB today. 20% increase in your holding in less than an hour. Target shareholders always win, always. So this is not, the slide is not about target shareholders. Target shareholders are great. They're happy. This is about acquirer shareholders because they pay for the transaction, which 60% of the time, on average, loses money. So you have to be careful as an analyst to get excited about an M&A. You should ask the following questions. Was it a cheap acquisition? By that I mean, what was the premium? Historically, the premium was between 20 and 30%. Did the company pay between 20 and 30%? Did they pay more or less? If they paid more than 30%, is there a reason why they paid more than 30%? If there isn't one, bad. Right? Is there a reason why they paid less than 20%? Again, 20, 30% is the historical average for this acquisition premium. If it's less than 20%, there might be a reason. It's not automatically, oh, it's a good deal. There might be a reason. The companies that they're buying is crap, so the discount so the premium they have to pay is not very large. Yeah? So always check what the premium is and why is it not within 20 to 30% if it's not in that range. Can you point your finger at the synergies, or is it a black box? Right? The company will tell you, oh, synergy this, synergy that. But can you as an analyst point your finger and say, oh, I get it? Yes. Example there is, for example, a company that has created some product, a small company, gets bought out by a big company that had already an infrastructure, right? So very common in pharmaceuticals, some small company, maybe in a university, creates some kind of a drug or a medicine for some horrible disease, but they don't have the infrastructure to sell it to customers, to develop it, have it tested by the government, approved, and then sold. Large companies have that. So is the large companies, Pfizer, Merck, or GSK, buying a small company so that they can take their product and use their infrastructure to access a lot of customers? That's good. That's what you want. Or is it you have no clue why the company is saying synergy this, synergy that? That's bad. Another example is the acquirer hardened in battle? Have they done acquisitions before? And if so, what was the premium? And did the acquisition work? You can go back and see what the acquisitions were, how much they paid, and if the integration of the two companies worked. You can do that as an analyst. If it was a good story, if it worked, everybody made money, the acquirers, shareholders made money in the long term as well, that's a good sign. If the acquirer companies uses the word strategic, we're making a strategic acquisition, sell the stock, recommend a sell. When they use strategic, that means it's NPV negative. Not good. Not good. I think I mentioned this before. QBE is a great company in Australia that does a lot of small acquisitions. They do acquisitions all the time, and they buy small companies. Targeted acquisitions generally are much more likely to be successful than some big acquisition to change the game. Right? Cycles. So that's it for the acquisitions. Be careful. The macroeconomic cycles. How long do I have? It's too much. Okay, I want you guys to go to this presentation. So how about I finish there in this slide, and I'll have a workshop this week on Thursday, and finish it. And if you don't want to come, that's fine. It's going to be recorded, but I want to finish it because it's. If you want to go to the presentation, you should have the opportunity. I think it's going to be a great presentation. Okay, so see you in the workshop for those who will show up. But it's going to be recorded. you going to the presentation? Do you know where it is?
I don't.
We'll follow you. Yeah, you can ask. Yeah, you can calculate it that way. So that's one way. You can sort of boil it down to a ratio and to see how much the company has to spend per dollar of sales relative to forecasting. You can do it that way. Or you can, or the other thing you can do is you can predict, you know, for this growth, for that company to continue on how much the company has to spend in order not to just improve the depreciation. So this is what the future company does.